It's hard to make 1-year predictions with something so volatile. My expectation would probably be higher, but I also would say I would also doubt that it'd be all-time highs.
No,
So my
agree with
expectation would be somewhere between here, like higher than here, lower than it's been, with the caveat that, I mean, if something severe happens and you have some sort of crazy liquidity crisis, I mean, it's not out of the realm of possibility. It could be lower, but my expectation would be somewhere between here and prior highs.
Lyn Alden is an investment strategist and financial analyst. She is known for her expertise in macroeconomics, value investing, and portfolio management. Alden is also the founder of Lyn Alden Investment Strategy, a financial advisory firm, and provides investment insights and analysis to clients. In her latest interview on Bitcoin and the economy, she explains why she is not only bullish on Bitcoin, but thinks many investors and economists are underestimating the downside risks to come in 2023. Alden believes that a recession is inevitable due to the yield curve inversion, which has a 100% strike rate in predicting future recessions. However, despite all of this, she remains bullish on Bitcoin and predicts that it will end the year somewhere higher between where it's trading now and its all-time high. Make sure to stick around to the end of the video where Alden explains what she is most bullish on and excited for Bitcoin. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
So I think it's been somewhat surprising how resilient so far the economy's been to recession, but I still think the picture does not look very good for 2023. It depends on a few different variables. So right now, for example, the U.S. yield curve is inverted, which means that the 10-year treasury is a lower yield than the 3-month treasury. The last 8 recessions, the yield curve inverted before the recession, and there's been no false signals, right? So it's never inverted and then there's no recession. Now, the caveat though is that sometimes it's like, a recession happens 2 months later and sometimes it happens like 2 years later. So there's a pretty wide gap for how long it can take for a recession to materialize, number one. And another challenge is that monetary policy happens on a lag because, especially in the United States and in a number of other countries, a lot of the debt is fixed rate. Just because mortgage rates, for example, shot up dramatically does not mean that the average American homeowner is paying a higher mortgage rate. Basically means that fewer mortgages get taken out at those higher rates. Fewer people ever want to leave or sell their current home. They want to lock in and keep their current mortgage rate. And so basically a lot of those are unaffected by the increase in rates. And so what happens is quarter after quarter, potentially year after year, as rates are at a higher level, some percentage of debt matures and gets rolled over. Like some corporate debt matures and gets, refinanced at these higher rates. Some people just have to move. Things happen, and then so low interest rate debt gets refinanced at higher rates, and that eats into incomes. It eats into things that they otherwise could spend money on. More of it goes to bondholders, banks, things like that, and away from the non-financial industry, and that can contribute to recessionary conditions. Especially because if you look at office commercial properties, they've never recovered yet from the combination of COVID and remote work. Right. So it's not that, remote work was always going to happen to some degree. And what COVID did was say, OK, we're going to take the next 5 years of remote work and push it into 3 months. That kind of trend was rapidly accelerated. And so even as it bounces back somewhat, a lot of companies have already decided that they need less office space than they used to. And so there's higher, vacancy rates, for example, in New York office real estate. I'm sure many other cities as well, including cities throughout Europe, cities in other countries. And so over time, as those holders of those properties have to refinance their debt at higher rates, that just puts pressure on them. And so I think that it's one of those things where we're kind of in a more stagnant environment right now, and we'll see if it descends into an outright recession. So right now, U.S. unemployment, for example, looks like it's bottoming and maybe turning up a little bit. You see consumer confidence, CEO confidence, measures like that are very low. The one saving grace that is somewhat, I think, keeping things afloat is that if you look at this year, the dollar index was soaring, which again, to my prior point earlier in this discussion, puts a lot of pressure on the entire world. But in the second half of the year, you've had like a rollover in the dollar index. It's kind of left off some pressure. And so that's been a constructive environment for a lot of developing countries, a lot of just indebted entities around the world, and it's given them a little bit of like a breath of life. And combined with the China's reopening, that's kind of the one variable to keep watching to say, okay, the U.S. is kind of in some ways purposely putting itself into a recession to try to regain control of inflation. But then the question is, as the market, looks at their inverted yield curve and maybe stops, paying more for the dollar, it allows these other indebted entities around the world to potentially stabilize and start doing okay. So I'm perhaps less bearish on the rest of the world than the average person is, but I still think that 2023 does have a lot of risks for recession or near recession, just overall kind of weak economic growth. Like if you said, how high do you think the Fed's can be able to tighten interest rates before they start causing problems? My number was probably around 3%, but they've already been able to get up to 4%. I think part of it was how quickly they did it, because as I mentioned before, a lot of this operates on a lag. So it's almost like there's very little difference. If you go to like 0% to 3%, like in 1 year, or 0% to 5% in 1 year, that almost doesn't make a difference because refinancing activity came to a halt pretty much. And so it's almost like that extra number barely matters in the near term. Where it starts to matter is quarter after quarter. As this plays out, that's where I think it starts causing issues. So I think it's a matter of time rather than just height in terms of interest rates. It's always hard to measure how much kind of excess liquidity is still in the system, right? So people got stimulus checks, they got child care tax credits, PPP loans that turn into grants. So basically millionaires were given, another like $500,000, things like that. And that's just money that's kind of like sitting there, and they kind of like drain that out over time. It starts getting diffused throughout the economy. And so some people had higher savings rates or, higher savings stashes stored away than I think some analysts realized. And so, I think quarter after quarter, it gets harder. The comparisons get harder from prior quarters as some of the conditions, basically as conditions stay very tight. So I think that's probably one way to look at it, that these things take time. And then also the way I was phrasing it was the Fed can tighten, but they can't normalize. If you look at, for example, U.S. debt, the average maturity is something like 5 years. Now, it's somewhat front-loaded because you have 30-year debt on one hand, and then you have, trillions and trillions of dollars in T-bills, which is, that all refinances within, say, a 2-year period. If they raise rates to 5% overnight, it doesn't mean that all U.S. debt is now 5% higher. It basically means that, starting with those T-bills, some of the existing short-term debt starts getting refinanced at higher rates, and then it turns into the 1-year treasuries and then the 2-year treasuries, and it's basically more of that maturing debt gets refinanced at higher and higher rates. And so there's a very big difference between, say, holding rates at 5% for 5 years versus doing it for 1 year, because more and more of that debt gets refinanced at that higher rate. And so the way I would phrase it is that the Federal Reserve is unlikely to get back to a period of positive real rates and then maintain it for years. But they can get to either positive rates in the near term, or they can get up to higher rates while inflation is still high. So, for example, what's remarkable is that as much as the Fed has tightened, they're still below the official inflation rate year over year. And so they're still in negative real territory. Now, they are higher than inflation break-evens, which is, supposedly the market's estimate of forward inflation. So they're positive in that sense, but they're still below trailing year-over-year inflation. So they've tightened, but it's not like they've done like a Volcker or 1970s thing yet. Right. So that's kind of how I'd phrase some of those aspects. Another thing I look at is that because this recession has impacted higher wage workers more, so there's been a shortage in things like, say, food workers, and a lot of people losing their jobs are like tech workers, Silicon Valley workers. A lot of those people have severance packages, and so they don't go and apply for unemployment right away. And so it doesn't necessarily show up in the, say, initial unemployment claims data as quickly as it would if people in the working class or the lower half, the middle income class gets laid off. And so I think that can slow down how that shows up in the data. And so, but I'm looking forward now to 2023 to see if we start to get more unemployment rate ticking up. And so that's what I would look at, the combination of PMIs, unemployment, and things like that, as well as, the Atlanta Fed does a pretty good real-time estimator for what the quarterly GDP is going to be like. So in this quarter, they've been tracking what they think is going to be by the end of the quarter, which of course isn't reported till the next quarter. All throughout next quarter, they'll be tracking it, which again, we won't find out till quarter two what quarter one's GDP was. So I look at that as a somewhat real-time estimate for at least the direction of where things are headed as this kind of plays out. I think for Bitcoin, my interest is in probably like infrastructure scaling. So things that Breeze is doing with Lightning, Breeze, Blockstream, making kind of the back end more efficient. Things like Fedimint, I think they're going to be kind of at full gear throughout 2023. I think ways to make the network more private, more scalable, not just for Lightning, but just overall Bitcoin usage. Anything that makes Bitcoin more fungible and gives people a bigger range of options to use. So they can use the base layer, they can use Lightning, they can do something custodial if they want to. There's this whole kind of stack that they can pick whatever serves their need the most. And so for me, it's looking at kind of the classic bear market building situation. And so, for example, I'm in a fortunate position because I advise Ego Death Capital, and I get to talk to the founders that we're looking to invest in or that we have invested in, and just kind of see the work that they're building and see what they plan to do and trying to do our best to help that happen.